If you have at least $1,000, you need to watch this video. The truth is, if you have that money sitting in a bank account, it's rotting to inflation every single day. I'm going to be explaining an extremely simple way to start making wealth using just $1,000. And it's also the same framework that I used to make my first $100,000 at age 22. This is a strategy that anybody can follow no matter their age range or experience level. The goal is for anybody to be able to approach this information and utilize it in their own personal strategy so it can mold around your needs. Now, before we get into the strategy itself, there's two potential roadblocks you may need to handle before doing this. One of these is high interest credit card debt. The reality is it takes a massive toll on your finances and it'll prevent you from making any return on any investments. Credit card interest is usually over 20%, which absolutely wipes out any kind of investment gain you can make. If you guys want me to make a video on handling or paying off debt, especially credit cards, please do let me know in the comments. But if you're in that situation, your first $1,000 should absolutely go to your credit card debt. Alright, now that we got that out of the way, on to the second potential roadblock that you may have, and that's going to be not having 3 to 6 months of your expenses in a high yield savings account. Now, of course, 3 to 6 months of expenses is going to vary for a lot of people. Some people may still live with their parents, some people may be out on their own, or have a family to take care of. Whatever your situation might be, 3 to 6 months of expenses in a high yield savings account is just absolutely essential. It's essentially just going to be the balance that you fall back on in case of any emergency. So the hope is that you never have to use it, but it's always there just in case. Now, by a high yield savings account, I am talking about a savings account that offers at least 3% on your money. Can find better ones that give you like closer to 5%, but those are pretty rare and typically they don't keep up that rate for the long term. But again, anything is better than having it in a normal bank account or a normal savings account. So if you can match or beat inflation, that's optimal. Alright, so now that we've got all our bases covered and we're ready to start investing our money, I'm going to explain the 3 different approaches you can take when it comes to using that $1,000 toward building some wealth. I'm going to be categorizing these as lower risk, medium risk, and higher risk. The lower risk bracket is intended for people who are maybe a little bit older or have a family or just really want to completely set and forget it. The medium risk approach is probably good for the average person, not overdoing the risk, but also leaving a considerable amount of room for growth. And lastly, we have the higher risk approach. This is mostly intended for people who are a bit younger and have a lot more time for things to compound and for mistakes to potentially be made. Again, it is higher risk, so there's a lot more potential upside, but that also comes with more risk. Now, for me personally, when it came to making my first 100K, I did use the high risk strategy. When it comes to using your $1,000 in the lower risk approach, it would be divided up into what you see on screen now. So 60% of that would go to VOO or VTI. These are ETFs that follow the S&P 500. Now, to briefly explain what that is, an ETF is like a basket of different stocks. And usually these are from the same industry or they're related to each other in some way. In this case, the S&P 500 ETFs are covering the top 500 companies in the US stock market. So it's a way to get exposure in all of the top companies without betting on just individual ones where you hold a lot more risk. Now, the next part of this allocation is going to be 20% of VXUS. It's another ETF, but it's focused on the stocks that are not in the United States market. So you're getting exposure to 8,600 or more large, mid, and small cap stocks from the global markets. Now, the reason to have this is to hedge against potential downfalls in the US economy or the US stock market. There can be some years where other countries' markets perform better than the United States. And surprisingly, we actually saw that this last year. If you look at the last year's performance of the S&P 500 versus VXUS, you'll see that the global markets actually did better. Now, on to the final part of the allocation. It's going to be 20% bonds. Now, I'm personally not the biggest fan of bonds, but they do minimize your risk. They're extremely consistent and will give a pretty good return. But if you really just want to maximize stability, that is where I'd recommend putting the remaining 20%. Alright, so we've covered the low risk. We're going to move on to the medium risk approach. So the first portion of this is going to be 70% into VOO or VTI. So right off the bat, we have some very good S&P 500 exposure. We're also going to throw in 15% of VXUS. So we at least have a pretty good amount of hedging against the US market. And then this is the part that spices it up a bit, 15% into specific sector ETFs. Now by that, I mean an ETF that follows a specific sector such as like energy, industrials. You could have some like a tech focused one, semiconductors, essentially targeting certain industries in particular to try to increase your returns. To give you an example, one of the things I used to invest in was FTEC, and that's like a technology stock. It's information technology. So the large cap tech stocks are going to be in there, but there's tons of different options out there, and it's worth doing some research on. If there's any specific industries that you think are going to do well in the short or long term, why not get an ETF in that field? So obviously the specific sector ETFs definitely spices up the risk a bit. If you did want to change a little bit up, you could allocate more of what is going to the VXUS to something like gold or silver, but there's plenty of stuff that you could change around by just experimenting. Now, the final approach being the high risk approach is what I used, and this one's definitely a lot more experimental than the other two. Right off the bat, we're starting off with 50% into VOO or VTI, your choice. We then have 20% allocation to specific industry ETFs. And then comes the much more risky part, which is 20% into individual stocks and crypto. And by crypto, I'm referring to the blue chip crypto currencies like Bitcoin, Ethereum, Solana. They're really the ones toward the top. However, if you choose to mess with altcoins and things like that, or really low cap stocks, that is totally your prerogative. Now, lastly, we have 10% into VXUS or gold/silver, so precious metals. And that essentially wraps up the different approaches for this investment strategy. Now, the important thing that I haven't covered yet is where do you actually buy these? You can buy these in either a taxable brokerage or a Roth IRA. There are other places, of course, where you can buy ETFs and stocks, etc. But for the purpose of this video, those are the two. There are multiple different platforms where those two kinds of accounts can be started. I personally use Schwab, but you can use Vanguard, Fidelity. Those are really the main ones. There are also ones like Robinhood. I do plan on going more in depth into the differences between a taxable brokerage and a Roth IRA, as well as perhaps a 401k. And I may also make a video on the different platforms and the differences between them, the similarities. So be on the lookout for that as well. But to finish things off here, I want to show you the potential returns of each of these approaches to this investment strategy. Now keep in mind these are going to be very rough. Things like ETFs and individual stocks really can't be factored in because there's so much variability. Now in the low risk allocation that we talked about, where it's 60% VOO/VTI, 20% VXUS, and 20% bonds, you'd be looking around 7 to 8% as your average annual yield, which completely blows bank accounts or even high yield savings accounts out of the water. Does that mean there are not down years or any risk involved? No, of course not. But when it comes to money that isn't an absolute necessity, I would take my chances. But the crazy thing to think about is if your $1,000 is compounding at 8% and you aren't contributing any additional money each month, that $1,000 will be worth $21,000 after about 40 years. If you manage to contribute just $100 a month after your initial $1,000, you'd be looking at $332,000. Now it's important to keep in mind that $1,000 is just the start, and ultimately you'll contribute a set amount each month to really compound your growth. Now because we can't accurately calculate the return of a medium or high risk portfolio just because there's so much variation, I'll just cover what some of the gains would be for Bitcoin and QQQ, which is one of the top ETFs for tech stocks. So in the last 5 years, QQQ has grown 89.38% as of recording this video, which is roughly 18% per year. Now Bitcoin on the other hand is extremely volatile, so it really depends on where you're placing your date marker. Back in roughly March of 2021, we saw it make a huge spike up to around 50K, and in 2022 there was a huge downturn, putting it all the way down to 17,000. But in just over 3 years from that low point in December of 2022, we have seen it climb all the way to $120,000, which means if you had bought the low and sold the high, you'd be making roughly a 7x on your money in just over 3 years. Now that's assuming you did everything perfectly, but even just holding blue chip cryptocurrencies for the next, 5 to 10 years, we really don't know what's going to happen. The picture I'm trying to paint here is with more risk comes more potential return, and there's a lot of room to grow on everything in this list. And with that, I think we'll wrap this up. If there's anything you guys would like to see in future videos, please do leave a comment down below. If you liked this video or found it informational, helpful, anything like that, please do leave a like and subscribe. I'll be making a lot more content like this. Your guys' support thus far has been very appreciated. Thank you so much for watching, and I'll see you in the next one.